Welcome, everyone, to FX Street. It's 8:31 a.m. Eastern. It's Wednesday, April 14th, 2010. My name is Adam Rosen. Very much thank you for joining us today. We have a great topic to talk about. It's the recent central bank meetings that I think are going to play a very important role in the coming months as far as the trends that we examine in the foreign exchange markets. What we're going to do is take a look at those central bank decisions, and then we'll look at the charts and see how that impacts our potential trades. And if at any time you can't see the charts or if my voice cuts out, please let me know. I'll be more than happy to refresh the system. Without further ado, we'll get started. Now, the first website that I'd like to take a picture of over here is the Daily FX Central Bank Calendar. It's a very helpful website, www.dailyfx.com. A number of different websites have these calendars, and essentially what it does is it just shows all the different central banks of the 8 major currencies we follow. And we can see recently in April 8th, we had the European Central Bank interest rate decision. On April 8th, we also had the Bank of England interest rate decision. And then recently as well, April 6th, we had the Reserve Bank of Australia interest rate decision. So we're going to take a look at these decisions, the statements that were released, and we'll see how that impacts our trades in the future. So we're not going to read everything, but we'll try to really cover what's most important. So the European Central Bank decision is as follows. Ladies and gentlemen, the Vice President and I are very pleased to welcome you to our press conference. This, by the way, is from the President of the European Central Bank, Jean-Claude Trichet. He says, we will now report on the outcome of today's meeting that was on April 8th of the Governing Council, which also was attended by the Commissioner Rosen. Based on its regular economic and monetary analysis, the Governing Council decided to leave the key European Central Bank interest rates unchanged. That was at 1%. As expected, the current rates remain appropriate, taking into account all the information and analysis that has become available since our meeting on the 4th of March. Price developments are expected to remain moderate over the policy relevant horizon. The latest information has also confirmed that the economic recovery in the euro area continued in the early months of 2010. Overall, the Governing Council expects the euro area economy to expand at a moderate pace in 2010 in an environment of uncertainty, with the growth pattern possibly being uneven owing to a number of special factors. And we can read on, but without going any further, we can say that the issue in Greece, or the economic trouble in Greece, is probably one of the top problems or issues in the European Union. So until we see some sort of resolution with Greece, I don't think that you're going to see interest rates rise at all anytime soon in the euro area. And if you had watched this press conference, the European Central Bank, well, actually analysts that were watching the European Central Bank press conference, they had stated afterwards that many now expect, or do not expect, I should say, that the European Central Bank will raise interest rates maybe until the first quarter of next year. Now, why is this important to us? Because we know the foreign exchange market moves. And one reason why it moves is the anticipation of higher or lower interest rates. If we know that the European Central Bank is not going to raise rates, probably will not raise rates until next year, and we only have 1% interest rates in the euro area, well, there's not a lot of reason to buy the euro. And that's why the euro has been so weak, and I think that's why the euro will continue to be weak. Now, when we talk about currencies, when we talk about these economies, we have to understand that there's two sides to the coin. We have the monetary policy, where, let's start from the beginning. We have two basic factors. We have to look for growth in an economy, and we also have to look for inflationary pressures. In terms of growth, we want to look for jobs, non-farm payrolls. We want to look for the GDP, the gross domestic product figures, to be better, to continue to improve. We want to see the economy grow. On the other side, we want to watch inflationary patterns. Inflation is, the prices that we pay, most certainly watched by the CPI. Today, about 5 minutes ago in the U.S., we had the Consumer Price Index, and that measures a basket of goods or services that represent, the average consumer in any given nation. So as inflation starts to rise, as things become more expensive, the central bank, like the European Central Bank, will raise interest rates to combat the fear of inflation, to combat the risk of inflation. Now, that is also assuming that we have a moderate amount of growth, that the GDP numbers, the gross domestic product numbers, and jobs numbers continue to improve. has not really been the case. We say in the U.S. we have 9.7% unemployment. The last I read in the euro area, it's 10% unemployment. So that certainly does not bode well for the European Central Bank to raise rates. And certainly the issue in Greece has been very, very bad for the economy overall. So we certainly do not expect the European Central Bank to raise rates, and therefore I would not expect very much that the euro is going to see any kind of massive rally to the upside. Now, eventually things will turn. Eventually we'll see the unemployment rate in the eurozone move from 10% on down. Eventually we'll start to see the inflationary numbers start to pick up, and we'll see this uncertainty in Greece leave the perception, so to speak. The perception become better. When that occurs, eventually it'll occur, and when it does occur, what we'll see the euro start to rise. I don't think we're going to see that anytime soon. Let me just touch on one other quick point from the European Central Bank decision, or the European Central Bank statement. This is a couple paragraphs down. They say, let me now explain our assessment in greater detail, starting with the economic analysis. Benefiting from the ongoing recovery in the world economy, the significant macroeconomic stimulus, that's fiscal policy, by the way, provided, and the measures adopted to restore the functioning of the banking system, the euro area economy grew by 0.4% in the third quarter of 2009, after a period of sharp decline, while in the fourth quarter real GDP was flat. That's not good. That's according to the Eurostat's second release. Gross domestic product was flat, and that we want to see growth in the GDP. Available indicators, in particular, further positive information from business surveys suggest that the economic recovery in the euro area continued in the early months of 2010, although it may have been affected by a number of special factors, including adverse weather conditions. As a consequence, euro area real GDP growth is likely to have remained uneven around the turn of the year, making it advisable to look through quarterly volatility and to compare growth development on a half-yearly basis. That means the next half a year is when they're going to take another serious look to see where we're at. Now, really briefly, turning to monetary analysis, the annual growth rate for M3 was negative 0.4% in February. Annual growth in loans to the private sector also remained weak at negative 0.4%, despite a positive flow in the month. Overall, the latest data continue to support the assessment that the underlying pace of monetary expansion is moderate, and that in the medium term, the inflationary pressures associated with monetary developments are low. Remember, we talked about growth on one side of the coin, and then we talk about inflation. They're saying not only was GDP flat and actually negative in some respects, the other side of the coin, the inflationary pressures, they said inflationary pressures associated with monetary policy, monetary development are low. Therefore, inflation and growth, both factors are telling European central banks, do not raise interest rates. The growth of M3 and loans is likely to remain weak also in the coming months. So I think it's pretty clear cut, at least how I'm, sort of interpreting this, that the European Central Bank, to sum up basically, inflationary pressures are low, growth is low, and that they do not expect to raise rates anytime soon, and they will evaluate it on a half-a-year basis, every 6 months or so. Now, moving forward, we also had on the same day, on the 8th of April, we also had the Bank of England interest rate decision. The Bank of England's Monetary Policy Committee on the 8th voted to maintain the official bank rate paid on commercial bank reserves at 0.5%. They kept rates unchanged. That was, as expected, at 0.5%. The committee also voted to maintain the stock of asset purchases financed by the issuance of central bank reserves at £200 billion. The minutes of the meeting will be published at 9:30 a.m. on Wednesday the 21st. So we don't have the minutes yet. But just a little bit further, the Bank of England actually said very, very little about, we just saw the European Central Bank decision. The statement afterwards, the ensuing statement was, a few pages long. Bank of England said very, very little. I found that kind of curious, but we usually have to wait for the minutes at any rate, and that will be the 21st of April. The previous change in bank rate was a reduction of 0.5 percentage points to 0.5% on March of 2009, meaning they have not changed rates since last year, March. The most recent change in the size of that program was an increase of 25 billion to a total of 200 billion pounds. on the 5th of November, '09. In line with the committee's announcement last September, the timing of the general election means that the next Monetary Policy Committee meeting will conclude on the morning of May the 10th of this year. Now, they mentioned something also. We have elections coming up in the UK, and that can certainly play a very, very significant role in the future, how we assess the economy in the UK, how strong it will be. I am not personally, to give my own 2 cents, I'm not as bearish. I'm a little bit more positive on the UK economy and the anticipation of maybe higher rates than the European Union, just simply for the fact that there's nations like Greece that are going through such hard times right now that it certainly does not bode well. I think the UK is certainly not out of the woods, but I am a little bit more bullish, although I still do not think that we're going to see any serious trend in the pound to the upside anytime soon. Technically, we'll look at the charts, we've had nice bounces off the bottom, but a bounce off the bottom is not the same as a rally. In fact, let's go to the charts really quick and we'll see what we're talking about over here. All right, so the first chart we're looking at, you should see, is a euro-dollar weekly chart. Normally, I use daily charts for those of you that listen to my webinars. But the weekly chart does a nice job of sort of capturing the entire trend, the entire pattern. And what we see is a massive triangle consolidation pattern. Ultimate uptrending support emerges near 129.70. We can say 130. Downtrending resistance emerges near 149, and an intermediate resistance maybe near 140. We're at 136.26 right now, so we're sort of in the middle of the range. We do not see a strong trend at all. In fact, it's very much range bound. And if we go to a daily chart, we can see the euro dollar really has not done anything particularly fantastic to the upside or downside in quite a while, actually going back to the beginning of February. So for those of you that trade the euro dollar, you probably noticed the euro dollar does not move very much. Now, getting back to ourselves, as we are foreign exchange traders, what do we look for? I think the best way to trade the foreign exchange market is to look for a trend. Well, how do we find which currency pair? A lot of people ask, what's the best currency pair to trade? There's always a different answer. We want to look for a currency pair where one currency that hopefully we buy goes up based on fundamental forces, the anticipation of higher interest rates, a strengthening economy, lowering unemployment rate, the CPI, the inflationary numbers to go up, and technically, obviously, we want to see the same hold true. And the other currency in the currency pair that we trade, the one that we hopefully sell, we want to see either a flat or neutral stance fundamentally, or a deteriorating condition where we see very, very little anticipation of higher rates. Well, in the U.S., I don't think we expect higher rates anytime soon. That also holds true in the European area. So when we have a weak dollar fundamentally and a weak euro, there's really not a lot of reason to buy the euro dollar or to sell the euro dollar currency pair. When we have two currencies kind of both relatively weak fundamentally, there's not a lot of reason to buy it. I think that's why the euro dollar has not moved. Same holds true for the pound dollar. The pound dollar has bounced up a little bit higher than the euro dollar has as of late. I think the numbers have been just slightly better. We're at 154.54 on the pound dollar. Recent swing highs take us up to 154.84 on April 12th. Now, it's important because if we overtake that 155 level, then we will now see levels we have not seen on the pound dollar going all the way back to late February of this year. And that means that all those traders that bought the pound dollar, once we go above 155, they're going to start making money. All those shorts are going to start losing money. So I think a break above 155 could potentially take the pound dollar up to former support levels, which might act as new resistance near 160. So even if you're a day trader, I know I'm certainly very aware that oftentimes I talk about the markets on a long-term macroeconomic basis, but even for those swing traders and day traders out there, I always like to say that even if you're a short-term trader, you should always try to base your trade on a long-term fundamental opinion. Because after all, if we would know, if we were certain, if we had a crystal ball and we were able to predict the future, and we were able to know, okay, the pound dollar this time next month, I think it's going to be at 160. That means it's going to move up 500 pips in the next 30 days. I would have to believe that even a short-term scalper or day trader, we would want to try to only look to buy the pound dollar because it's probably going to go up a lot more than it's going to go down. So that's why I think it's important, even for short-term traders, to identify these these technical levels. Unfortunately, with a pound-dollar currency pair, there's really not a lot of fundamental reason why I think the pound-dollar is going to go up. And again, we do not have the minutes from the Bank of England meeting yet. So when we get those minutes in the next week or so, we can make a much better educated guess. Now, let us go to what is, I think, one of the most exciting fundamental events over the past couple of weeks, even more. This was on April 6th of this year. This website is the Reserve Bank of Australia website. This is stated by Governor Glenn Stevens. And they said on April 6th, at its meeting on the 6th, the board decided to raise the cash rate by 25 basis points to 4.25% effective the 7th of April 2010. The global economy is growing. Now notice, we're going to read the statement here and notice the difference simply in the tone, how much more optimistic the Reserve Bank of Australia is as opposed to the European Central Bank. We don't know the Bank of England, but then again, they have 0.5% interest rates in the UK, and they're not raising rates anytime soon. So we can sort of infer that they're probably not very, very optimistic, at least in the near term. However, notice the optimism out of Australia. The global economy is growing, and world GDP is expected to rise at close to trend pace in 2010 and 11. The expansion is still hesitant in major countries, and they refer to Greece in particular, due to the continuing legacy of the financial crisis, resulting in ongoing excess capacity. In Asia, where financial sectors are not impaired, growth has continued to be quite strong, contributing to pressure on prices for raw materials. It's important why they talk about raw materials. The authorities in several countries outside the major industrial economies have now started to reduce the degree of stimulus to the economy. And on Bloomberg.com a few days ago, there was an interesting article mentioned how this recovery we can see in India and other nations that outside the 8 major currencies that we follow. Now we know that Australia is a very, very large producer, a very large source of raw materials. Gold, copper, silver, platinum, palladium, all that good stuff that we use to make goods and services. A lot of it comes from Australia. So when we talk about raw materials, we should understand that the higher prices and the increased demand for these raw materials inherently benefits Australia. They continue. Global financial markets are functioning much better than they were a year ago. Notice the difference between the European Central Bank, which is not very optimistic at all, and the extraordinary support from governments and central banks is gradually being wound back. That's talking about fiscal policy, not so many bond purchase programs. Credit conditions remain difficult in some major countries as banks continue to face loan losses associated with the period of economic weakness. The concerns regarding some sovereigns appear to have been contained at this stage. Australia's terms of trade are rising, added to incomes and fostering a buildup in investment in the resources sector. Under these conditions, output growth over the year ahead is likely to exceed that seen last year. That's good. Even though the effects of earlier expansionary policy measures will be diminishing. The rate of unemployment, I want to look at Australian unemployment, by the way, it's big. It's good. The rate of unemployment appears to have peaked at a much lower level than earlier expected. They have nothing but good things to say in Australia. The process of business sector deleveraging is moderating, with the pace of the decline in business credit lessening and indications that lenders are starting to become more willing to lend to some borrowers. Remember, the other 2 statements we read, they said lending is not very good. Now, inflation at the bottom. Inflation has, as expected, declined in underlying terms from its peak in 2008, helped by a notable slowing in private sector labor costs during 2009, the rise in the exchange rate, and the earlier period of slower growth and demand. CPI, Consumer Price Index, inflation has risen somewhat recently as temporary factors that have been holding it to quite low rates are now abating. Inflation is expected to be consistent with a target in 2010, and that is good. So remember, we have 2 sides of the coin. We have the growth. We have jobs. That's on one side. What did the Reserve Bank of Australia say? They said that the unemployment rate peaked at a much lower level than earlier anticipated. This right here. The rate of unemployment appears to have peaked at a much lower level than earlier expected. And then they talk about inflation. They said, well, we're off our peaks from the 2008 peaks, but they said CPI inflation has risen somewhat recently as temporary factors, etc. So, to sum up, I would say that, and for all due reason, I would say that the economy in Australia is probably the strongest out of the 8 currencies that we follow. You know, the euro, the pound, the Swissy, the dollar, yen, CAD, Aussie, Kiwi, etc. Australia seems to be the most healthy, and it should be no surprise that the Reserve Bank of Australia has now raised rates. I believe it's 4 times in 5 meetings or 5 times in 6 meetings. Essentially, they've raised rates from the low of 3%. Now we're all the way back up to 4.25%. And you can bet that any continued amount of optimism that we're going to see, come into the market, any market, I think this will inherently benefit Australia. Before this meeting, I remember reading on Bloomberg.com about a week before the meeting, some analysts had started to turn a little bit bearish on Australia, not bearish, but a little bit less optimistic that the Reserve Bank of Australia would raise rates. And they said, hey, the Reserve Bank of Australia, we don't think they're going to raise rates. They've already risen rates a lot, and they're at 4% interest rates, and that higher exchange rate is starting to slow down the economy. They were wrong. The Reserve Bank of Australia raised rates. And in fact, I read another article on Bloomberg.com that actually mentioned a little bit of a housing shortage in some parts of Australia, which is sort of ironic because we have, if nothing but the opposite in the U.S. and in many, many other nations, the opposite of a housing shortage, excess capacity, which is what they were talking about. So there's very, very different conditions. Why is Australia doing that much better than most others? Well, they supply raw materials to a very close trading partner, that's China. And China has really been able to benefit. I read earlier today that, China, I believe, is what the growth rate in China is around 10%, and in other other areas in that region, 9% growth rate, 8% growth rate. We read on the European Central Bank statement, flat growth rate, zero, negative 0.4%, positive 0.4%. 9%, 10%, that's a lot better. Well, as China continues to absorb, a greater amount of market share, they produce that much more goods and services, especially goods. They have to buy these raw materials from somewhere. They buy them from Australia. And I think that's why Australia has really been able to do very, very well out of this entire mess that we've gone through. Let us look at the charts now and see what this looks like. So we have the Aussie dollar currency pair, and this is always a fun exercise. We're at 93.40 on the Aussie dollar right now, and I'll say this, two things. If we take out the 93.88 highs in April 11th, this is the daily chart, the next highest high is 94.04. That's the highs of November 16th of 09. But if we break above 94.04, look out. We will then see levels on the Aussie dollar we've not seen since August of 2008. Picture every single one of those trades that's open that bought the Aussie dollar. As soon as we cross above 9,400, every single one of those long trades from August of 08, that's almost 2 years, 1.5 years, all those long trades will be making money. All those short trades will be losing money. But what's even more unbelievable is to take a look at this very highest high, 98.49 were the highs in July 15th of 08. Go to a monthly chart. We have not seen higher highs. My monthly charts go back, at least to the late 90s, 1999 to be exact. That will then put us at 10, 11, 12-year highs at least. If anybody has an Aussie dollar chart that goes back before 1999, I'm curious to hear how far back we have to go to see higher highs. It could be an all-time high. So compare the Aussie dollar, which is 93.40. We're 65 pips away from very, very big highs. And again, zooming out to the daily chart again, we're not that far away. We're a few hundred more pips away from at least 10-year highs, and probably more than that, probably a lot more than that. And that is pretty miraculous. Compare that to the euro dollar, 136.32 currently. How far away are we from those 160 all-time highs? 2,500 pips, 2,500 pips. The pound dollar, zoom out on the daily chart. How far are we going back? Remember, we hit that 211 level. We're at 154 right now. That's a good, 5,000 pips as well. So compare and contrast against a relatively weak or benign dollar. I guess the right word's benign. It really doesn't have a very specific trend right now, the dollar. the Aussie dollar looks a lot better. I'm going to throw the dollar yen chart on in a moment. However, Swana, if I said that correctly, you read my mind because that was absolutely my next, you absolutely read my mind. Now, the ideal currency pair is, the currency trade is when we take one currency we think it's going to go up, and we take another currency we think is going to go down, and we put those two together to try to find the strongest trending currency pair. Well, so far we've discussed three currencies, and the weakest by far, at least, my opinion, I think is the euro, and the strongest out of three is the Aussie. If you put the two together, let's see if I can have it. I think I have a euro Aussie, currency pair. Euro Aussie, there we go. Alright, so we throw in a clean chart. Take away our max here. Okay. Go to a daily chart now. Fundamentally, it's a trade that makes a lot of sense. Well, have a look at this chart. The Euro Aussie, 145.91. With no further technical analysis, it's very, very clear to see the trend is your friend and the trend is going lower. This is a monthly chart now. My monthly charts go back to 1988 or so. Now, we're at 145.93 at the moment. The lowest lows on this current monthly candlestick is 143.43, about 250 pips below it. The next lowest low, by the way, is 140.24, and that goes all the way back to August of 1997. Essentially, we're trading at 13-year lows. Whoops, still see the Aussie dollar? There. Now, you should see now, please let me know if you don't. You should see now the Euro Aussie currency pair. Now, again, we're trading at 13-year lows. If you break below that 140.24 level, then the next lowest low is 137.40. That goes all the way back to 1991. I'm sorry, I corrected. So the Euro Aussie, take a look at its monthly charts. Zooming in on the monthly charts, count how many candlesticks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 15 consecutive months we have not seen a green candlestick. The last time the Euro Aussie closed in a positive or a green candlestick was January of 2009. That is a long, long time. Will it continue? Nobody knows for sure. But if I was a betting man, I would certainly bet in favor of the trend. Eventually, this trend will turn. I do not think anytime soon we will see a case where we'll see the euro overtake the Aussie with higher interest rates. However, in terms of trading, we always have to consider the contrarian point of view. Now, with that said, it's always tempting to consider the contrarian point of view and to say, well, look at the Euro Aussie. We went from 205 down to 145, 5,000, 6,000 pips. If I'm lucky enough to catch the bottom, maybe we bounce back up 2,000 pips. That could be a great trade. Well, I would say it's not a good idea for a couple different reasons. Number one is the carry trade. That's the difference in interest rates. You have much lower rates in the Eurozone at 1% than you do in Australia at 4.25%. So if we ignore all other fundamental factors, we have a majority of the capital tends to move into higher currency pairs, or currencies, I should say, with higher interest rates. So we certainly have to be aware and respect the fact that Australia has much higher rates. But more than that, the anticipation of higher rates. We say, okay, if things are good in China, we will see higher rates in Australia. If things are better in the Euro area, maybe we'll see higher rates in Australia. If things are better in the US, we'll see higher rates in Australia, because if things start to improve in the Euro area, that will also benefit Australia, because that simply means more consumers that will buy those raw materials from Australia. So on a fundamental basis, as far as the Aussie to the upside, fundamentally, it's a win-win situation, I think. I think if things continue to improve, Australia will benefit. And if things do not improve, where will they not improve? Well, things will probably not improve first in the Euro area, because things seem to be the worst there. So the Euro will go down. So the Euro Aussie, fundamentally, the trade makes a lot of sense to the downside. Now, if you're a short-term trader, and we don't always use monthly charts, there are other ways we can find the trades. This is a daily chart. Now let's go from an ultra long-term time frame to a moderately long time frame. Take a daily chart, take the peak, just as an average peak. This is April 28th of '09, so going back about a year. Draw a resistance level connecting significant highs. We can I like to connect the highest high to the next highest high. We can see here the candlestick actually intersects that high in July 13th of last year. However, the market more recently did respect that line, so I like this line. That tells us for long-term traders, let's see if we can find a parallel support level. In a downtrending channel, always draw resistance first. In an uptrending channel, always draw support first. Because in a downtrending channel, I want to trade always with the trend, in this case to the downside. Therefore, I want to look for a place to sell short. So long-term traders, the Euro Aussie, we want to sell short near resistance. We're at 145.96 right now. Unfortunately, that resistance is near 154, about 900 pips higher. So we have some time to wait with the Euro Aussie for a long-term trade. However, short-term traders, well, let's go to a 4-hour chart, and we can find smaller trends that emerge within the longer-term trend. And I'll actually tell you, I did not look at this chart before the webinar, but it actually very recently has given us a nice trade example. Let's change the color here. So the baby blue line is a long-term trend. We'll go to red lines for a medium-term trend. Draw our connecting support resistance levels as follows. Zoom in. Again, this is a 4-hour chart. Let me refresh my chart over here. Can everyone else see my charts? Please let me know just if you cannot see the charts. You should see a Euro Aussie chart. We should see now some red lines that I just okay, perfect. So if you cannot, by the way, if you cannot see the charts, you might want to try to log out and log back in really briefly. That might be the case. It seems to be working my end. Thank you very much for joining me, by the way. Now, 145.97 current Euro Aussie 4-hour charts. When did it give us the last time an opportunity to get involved in a trade? When we touched highs at 147.15, that was only about 118 pips away, and that was in the 13th. That was just yesterday. So yesterday was the last time the Euro Aussie actually gave us a balanced signal. If you want to sell short the Euro Aussie, I happen to agree with you. I would wait for the market to test and fail to break above this resistance, and that is currently, if you want to write it down, just under 147, about 146.72. Where do you want to place your protective stops? Above resistance at a logical point where you think the market's not going to go to, and we'll draw a yellow line to show you where the stops, red should be the stops actually, but we switched the colors. So I just drew the line to illustrate theoretically where the stops should be. Could probably move them a lot closer, but we want to sell short as close as possible to resistance. We want to place our protective stops above resistance. Maybe take half of the trade or a third of the trade off the table if you make a predetermined amount of pips of profit. Move the stop maybe to break even and hold on. Because even a short-term trade, we take a look at a daily chart, we have a long-term trade. And then we take a look at a monthly chart and we see even a longer-term trend. And these are the type of situations that really, that really look good, because this is the type of situation where you get involved in the trade and you can feel it when you're in the right side of a trade, because your trading account, you log on and say, oh, my trade now, I made 30 pips, and then I made 50 pips. So maybe it goes back a little bit, but it continues to do well. A friend of mine a long time ago, a trader I used to work with, he said something that I think rings very, very true, that when you're in the right trade, when you pick the right direction at the right time, he says, you're going to feel it, you're going to know it almost immediately. What does that mean? Does it actually mean you can feel it? You cannot feel the trade. But what happens? He logs onto his trading account a couple hours later, and he checks his position, and it's making a little bit of money, and that feels good. Hey, I bought this, or I sold that. Now I'm making 30, 40, 50 pips. Great. And then, you give it some more time, and then it makes 70 pips, and then it pulls back. And you had 70 pips of profits and say, oh, wow, I should have taken profits. But then immediately the trade starts going in your favor again. And when it pulls back, it does not pull back a lot. And it really doesn't give you a lot of heartache. Now, compare that feeling to the feeling of being in the wrong trade, which certainly happens to the best of us, where you buy or sell a currency pair, and almost immediately you start to lose money. You're down in the trade 10 pips or 20 pips. You log out, you log in a couple hours later, maybe you're down 40 or 50 pips. And then the market goes back and you say to yourself, okay, now I'm going to go back to break even. Maybe now the trade will start making money, and it goes up a little, but you never even get to break even. and then you're down 80 pips and 90 pips, and that feeling goes from bad to worse. Trust your feelings. You feel this way. I feel this way because of the profit or loss that we're making on the trade. But that feeling is certainly, I think, can be very, very indicative of if we have essentially picked the right side of the trade. The huge third angle on the monthly has 127.20 fibs. Let us take a look over here. Yeah, I tell you, I'll draw the fibs, but I would tell you I would not look very, very carefully to draw the Fibonacci levels because we've gone down so much so quickly. In fact, zooming out on the monthly chart, I really cannot find a lowest low that the fibs make a lot of sense. However, I will say this. Let us do this. We know the trend in the Euro Aussie is to the downside. And we know that in trending market conditions, the market tends to look like we're walking up or down a flight of stairs. So in this case, we're walking down a flight of stairs. We go down a lot, we go up a little, down a lot, up a little. Now, we know to trade with the trend. The trend is your friend. And we know that Fibonacci is best used in trending market conditions, not in range-bound patterns, not in triangle consolidation patterns. So we want to use Fibonacci. Let's take a look. I didn't even think to mention it, but it's actually a very good point. Let us take Fibonacci, and I have not looked at this chart before, so, it's a little bit new to me, but I think it will work. Take the highest highs of April 29, 2009, draw the Fibonacci levels down to the next most significant low. And what we'll see here, let's adjust this chart so make it a little bit better so everybody can see. Now, in a downtrending market, we know we want to draw Fibonacci from the high to the low, from the beginning of the trend to the end of the trend. Now, we draw from, again, the 120, the April 29th highs of 2009, April 28th actually, draw it on up, down to the lows of May 7th, 2005. The market sells off, rallies back up to a Fibonacci level. Fibonacci level, the 50% Fibonacci retracement level on May 14th. And then we go down. Where did we go down? We broke some new lows. In fact, the 23.6% Fibonacci projection level. Well, then we want to take our Fibonacci levels and take our new low and our new high. Take the new low, the new high. We draw Fibonacci levels now from the former highs, May 14th, to the new lows of June 11th of last year. We rally back up. Only the long candlestick wick was able to break above the 78.6% Fibonacci retracement level. When this occurred, we were able to draw our downtrending resistance. I love when Fibonacci and resistance levels and support levels intersect. Where did we go down from there? The 23.6% Fibonacci projection level, and then we stopped and we started to move back. This is very, very common. And I think if you continue to run through this exercise, take the new low and the new high, you will see we will trace back to a Fibonacci level, and then we'll break down and find new support on another Fibonacci level. We can continue to do this. Let us skip forward and draw the most recent line to give you an idea where the trade may end up. Take those highs of 159.49 on February 4th of this year. February 4th, let us assume now, we don't know that this is the ultimate bottom, but let's assume that the lows of 143.43 on April 8th of this year were the lowest lows. Well, zooming in, we can see that the market has touched and now turned back to the downside almost exactly the 23.6% Fibonacci retracement level, the medium-term trend line. So we see here a trend line and Fibonacci together intersect. Beautiful. Yesterday's daily candlestick high of 147.15 back to the downside. Where could we go? Well, then we look down to, we adjust it just a hair. All right. Where could we go? Well, the 23.6% Fibonacci projection level is the next logical stopping point. That's all the way down at 139.75. We're at 146 right now. That's a long way to go. Point A is the best, is before the last rise. Point B is the highest, and now we see point C. Yeah, absolutely right. By the way, when we talk about ADBC, if you were to think about Elliott wave analysis, you're absolutely correct. Now, there was a request earlier. I did not forget about the dollar yen, which is a very interesting currency pair. Now, in Japan, we always have to be aware that the Bank of Japan has historically very low interest rates because it is a little bit unusual in a sense. It's an export-driven economy. So they like low interest rates because lower interest rates mean a more favorable exchange rate to the rest of us. We can buy more Japanese products with a stronger euro or a stronger dollar. So so the Bank of Japan essentially keeps the Japanese interest rates very low. So do not expect rate hikes in Japan anytime soon. That is opposed to a capital-intensive economy like the U.S., for example, that the majority of our growth is derived from investment in real estate, investment in the stock market, investment in companies, etc. So we will see over time, as conditions continue to improve, hopefully, we will see certainly the dollar rise more than the yen. What's very interesting now is we see the dollar-yen daily chart draw the trend line going from April of last year, just not too long ago, going back to end of March of this year, we finally broke above this trend line. Well, what does that tell us? That tells us that we might be in store for something new. Now, zoom in on the dollar-yen daily charts, and we can draw a new uptrending support line. Again, remember, an uptrending market is significant lows. We draw support first. Hopefully, resistance will emerge in a somewhat parallel fashion. In this case, it did. And even more recently, we can connect to our significant highs. That actually works out very, very nicely. Draw the highs, by the way, from September 21st of last year. Draw that line across. 93.34 right now, breaking above resistance. The rule of thumb is former resistance, if the dollar yen pulls back, might become new support. Take a look, and if we assume, by the way, if we're under the impression that we think we're in a new trend to the upside, we can draw Fibonacci levels. Take the Fibonacci levels in the dollar yen from March of this year, drawing them up to the swing highs going to April 4th. We pulled back to 23.6% Fibonacci retracement level. We can also draw a horizontal line, which does match up sort of, kind of close in the 9,300 level. Actually, if you draw it on down, the former swing highs, former resistance becomes new support. The dollar yen very well could be in a new trend to the upside. However, there's not a very big carry trade right now. There's not a difference in interest rates. Interest rates in Japan are 0.1%. Interest rates in the U.S. are 0 to 0.25%. There's just very, very little anticipation of any rate hikes anytime soon in the U.S. And certainly nobody expects the Bank of Japan to raise rates. So I would not expect serious trends in the dollar yen to develop. If I had to guess, I would certainly guess that the dollar yen long term would probably go up more than down, but I don't think it's going to be spectacular, and that's the difference. Now the questions are, well, what about the cable yen or the cable dollar? Let's take a look at cable yen. Cable yen downtrending resistance 144.26. Today we hit highs 144.63. The highest highs we've seen in a long time are 144.87 on April 4th. So to answer your question, cable yen, technically, I would not expect a serious trend to the upside to develop until we go above 145. Write that down. Above 145, then we'll see levels we have not seen since January of this year. And the next swing high, if we break above 145, maybe we retest 149. But above 149, we have 153. Every few hundred pips, cable yen has a new potential resistance level. That's technically, so could we reverse to the downside? I don't love the idea about shorting the cable yen, not because there's a carry trade, but simply because if all of a sudden we have good inflationary numbers in the UK or better than expected numbers in the UK under any means, I think that you'll see the pound start to rally. So I don't want to sell short. I don't really want to buy it. I think we're going to be range bound. However, please be aware that technically, if the cable yen goes above 145, I think we're in store for a nice bigger pop. If you want to trade a currency pair, a yen cross, that has a better chance of creating a trend, well, think of the one currency that we seem to be very optimistic on, at least I am, the Aussie. Put it against the yen. If you don't want to trade the Euro Aussie, put the Aussie yen. We know interest rates in the Bank of Japan are not going to go anytime soon. Anytime we have any kind of growth in the world, Australia seems to benefit. Aussie is a logical choice. 87.13 currently, hitting highs at 87.53, which, by the way, just by 3 pips past the highs of April 7th, and zooming out by only 3 pips The Aussie yen actually touched levels we have not seen since October of 2008. Aussie yen 87.50 or above, I think looks great. Short-term traders, if we're above 87.50, I would only focus to the long side. I think technically and fundamentally, we could certainly justify a lot of reasons why it's going to go up. Some points here, and I'm going to go to pound dollar while I have about 30 seconds left. Yesterday, all yen pairs have made a huge turn up during the New York session, about 3% from the last move up. It's true, when there's any sort of optimism in the market, the yen crosses seem to benefit. Cable dollar, notice the difference. Remember Aussie yen? Just barely today, we hit levels we have not seen since October, but the cable dollar, not so much the case. 154.84 were the highs of April 12th. Again, if we break above 155, that would put us at February, late February levels, but that certainly is not the same thing as the Aussie yen or the Aussie or the cable yen for that matter. I don't like the cable dollar. I don't like the cable yen. You put a weak cable against a weak yen, a weak cable against a weak dollar. There's not a lot of reason for the currency pair to move. But when you put a very strong Aussie against a very weak yen, or a very strong Aussie against a very weak euro, I think you have a much better chance of a nice trend developing. Global economy is still prone to the bad news, and that will once more give strength to the yen, and the recession is far nice. You very well could be true. It very well could be right. We are certainly not out of the woods by any means in terms of a lot of the economies, especially in terms of Greece and also, well, the U.S. We have issues too. Since the beginning of March, all yen crosses are up. Yeah, it certainly has been. It's been a very nice case. So again, focus on, even if we're short-term traders, focus on the currency first from a long-term fundamental point of view. Where are interest rates now? Where do we think interest rates will go in the near future? How do we make this decision? Look at the central bank meetings. You know, they only happen every, 4 to 6 weeks. Look at the big numbers like GDP, trade balance, U.S. Today we had consumer price index, and we can make an educated judgment as far as which way we think the central bank will go and how soon they will move. And once we can make that decision, we take what we think is our best pick against our worst pick. We put those two together, and hopefully we find a very trendy currency pair. And like sometimes, just every once in a while, we find these currency pairs like the Euro Aussie, which certainly has, wow, nice trend to the downside. With that said, I am out of time though. However, if you want to contact me, please do not hesitate. Contact me directly, www.forestmatch.com. I want to thank you all very much for joining us. I want to wish you all a great day, all profitable trades. And we look forward to seeing you back.